Every year the word recession gets thrown into the news, and 2024 is no different. We have articles upon articles stating that 2024 could be the year of the recession. As we see here, another article, will we avoid a recession in 2024? US stocks slip from record heights as recession fears offset the rate cut optimism. We have another article here talking about how there could still be a recession due to the interest rates hikes which are stopping. And finally, again, more of the same, recession 2024, what to watch and how to prepare. So in today's episode, we are going to look at some of the most recession-proof stocks that you must own if you believe there is a recession in 2024. These are companies that have outperformed significantly the S&P 500 in the last recession, 07-09. We're going to take a look at these companies. We're going to look at their historical performance. We're going to look at their dividend safety, some important financial metrics, how well they did perform in the last recession. And as always, we will run them through our valuation model to find out what each one of these intrinsic value is, what is their acceptable buy price given our margin of safety. Now, as you probably would have guessed, the first company that we are looking at is Walmart. Now, year to date, they are up around 8.3%. They are pretty much in the midpoint of their 52-week range with a yield of around 1.47%. Now, if you're a shareholder over the last 10 years, well, this is a pretty nice upward graph. You would be up around 98%. Don't forget, it doesn't include those dividends reinvested, and they recently hit an all-time high of around $170. So let's take a look at our first recession-proof stock for 2024. Dividend safety, 90, very safe. We do like to see that. Market cap, 419 billion. They are a mega cap company. And when we look at those recessionary metrics, well, they increased the dividend during the 07-09 crash. Pretty much flat percentage sales, which was much higher than the average growth of companies in the S&P, which is around negative 12%. And this is the only stock that we're going to review and one of the few that did have a positive return during the recession, the S&P having a negative 55%. So let's take a look at this stock for 2024 and the possible recession that we may be looking to see. The latest increase of 1.8% this year. Not the greatest. For those that are regular viewers, you know we advocate 4% or more to keep up in line with inflation. Again, last 5 years, nothing to write home about with 2%. Last 20 years, though, double digits, we do like to see that. And when we take a look, they are 1 year away from officially becoming a dividend king. For those that are new, well, dividend king are companies that have increased their dividends for 50 years or more. Now, dividend yield theory states the company is undervalued when the current yield sits above the 5-year average. So we have a sign here for Walmart of reasonable valuation / possible overvaluation. When we look at the forward PE, we do see a sign here of some reasonable valuation, as the current PE is near enough that 5-year average of 23.3. And when we compare it to the consumer staples of 19, Walmart sits a few points higher. Now, let's take a look at the free cash flow payout, and as always, earnings is susceptible to manipulation by management through accounting. So let's draw your attention to the free cash flow payout. Below 40% for consumer retails. Personally, for me, the majority of companies, I use a blanket 60% rate. It does give me faith that management can offer nice double-digit increases. The last few years, around 50, the mid-50 to the low 50s is something that I'm happy with. 2024 expecting to go lower down to 43%. So I would like to see from Walmart some nice, at least high single-digit increases to the dividend in 2024. Free cash flow per share, well, 310 in 2014, 440 in 2023. It has increased over the last 10 years. Not very consistent. We see a lot of inconsistencies. 2024 it is expected to continue the uptrend. Sales growth, for those that are new, we focus on 3 to 7% for steady moderate growth as a real minimum. The last few years, in between that to 2 to 7%, so we can see it isn't a fast grower, but it at least keeps up with inflation over the long period. And we can see their top line has gone from 476 billion in 2014 to 611 in 2023. They also do share buybacks, returning excess cash to investor pockets, 3.28 in 2014, 2.73 in 2023. When we focus on the ROIC, now remember this is one of my 7 golden dividend metrics. What I look for is 10% or more. Gives me faith that management are essentially able to allocate that capital effectively. Well above 10% consistently with the last few years in the mid to high teens. So that is positive, gives me faith in management and their ability. Operating margin, they do fairly struggle with that. I would like to see a minimum of 10%, but as we can see, they have consistently had around 4 to 6%, which is a bit of a worry. As they continually get squeezed, it does mean that bottom line net income will get smaller and smaller. Free cash flow margin again below that 6%, so I would like to see this go back up, especially not as low as 2%. That is a bit of a worry, in my opinion, moving forwards. Net debt to EBITDA, earnings before interest, tax, depreciation, amortization, shows us two things. Shows us one, the dividend strength, safety, as well as the balance sheet strength. Below 3, these are the numbers of years it would take the company to pay off all of their debt net of cash on hand, and we can see that it is below that, which is a positive sign. In fact, 2024 is expected to be pretty much in line, so that gives us faith in those 2 points that we mentioned. Now, in terms of the valuation model, and those that are new, typically on the channel when we do in-depth reviews of each individual stock, we run through each of the 4 models, explaining the inputs and the outputs. But for today's episode, we will just run through the output intrinsic value calculator, and we do explain on each episode why we include or remove certain models. Now, for Walmart, we're getting an intrinsic value of $170, which is just the average of the 2 models we've used for today. Margin of safety, now typically we start off with 10%, and we use that if we believe it has a wide moat, strong financial metrics, good forward-looking data. And what we can see for the company, it is pretty much trading at a 10% margin of safety, roughly around that current trading price by around $1 or so. In terms of Wall Street and what they say, well, they do believe there to be some nice upside over the next 12 months. They see around 15% upside. So in conclusion, for Walmart, we believe based on our estimates and judgments, it's currently trading for a 10% margin of safety with around 10 to 15% upside per Wall Street targets. Moving on to the second company, we have McDonald's Corporation, ticker symbol MCD, up around 10% year to date. It is trading towards the mid to upper end of the 52-week high, and we see a yield of around 2.3%. Now, those investors who have been holding for the last 10 years would have a very happy 199% shareholder return. Doesn't include those dividends, and we can see it has hit its all-time high at just under $300, so it isn't too far off. Now, they have a dividend safety score of 77. They are safe. Market cap $211 billion, so it is a mega cap company. Now, the recessionary metrics, they increased the dividend during the 07-09 crash. Negative 6% sales, that is above the average growth. And they had a very, very impressive recession return of only 3% negative, as opposed to the S&P's negative 55. Dividend growth, what's not to like? 9.9% increase this year, 8% increase on average over the last 5 years, 17% over the last 20 years. There is a lot to love, and dare I say, I am McLoving it. Dividend growth, well, they are a dividend aristocrat, 25 years or more of increasing dividends. They're only 4 years away from becoming a dividend king. Now, in terms of dividend yield theory, well, we can see a reasonable valuation with that yield near that 5-year average. Likewise, the same could be said for the forward PE. In terms of the comparison, well, the consumer discretionary sector PE is significantly lower at 14.7. Free cash flow payout, fairly inconsistent. I do like to see below 60%. Some people will bring that down to below 50%, in particular to the restaurant industry. 2022 is 76%, although note 2023 is expected to be around 62%. Now, when we move down to the free cash flow per share, fairly nice. It has nearly doubled their free cash flow over the last 10 years. 430 to 745, 2023 expected to be even higher. Not as consistent as maybe you would like, but over the longer term, it is moving in the right direction. Sales growth, something that we do discuss quite a lot on the channel. It isn't one that is fast growing. It is not keeping up with inflation overall. And when we do take a look in terms of numerically their sales, it has in fact decreased from 28 billion in 2013 to 23 billion in 2022. And if you want to know more details, do check out our in-depth dive specifically on McDonald's that we did a few days ago. Shares outstanding, well, they do a lot of share buybacks, which is positive. Remember, it returns excess cash to investors. Just over 1 billion in 2013, 741 million in 2022. So they've bought back around 25% of those shares over the period. ROIC, what's not to love, around the mid-20s consistently over the last 10 years. 25% expected in 2023. Operating margin, free cash flow margin, 2 things I like about this. One, it is above the minimums we look for, but also note it is increasing over the longer term. 46% expected 2023, 29% on the free cash flow margin. So lots to love about this company and their financial metrics. Finally, the net debt to EBITDA, Slightly higher than what we look for in the restaurant industry at 3.78, but it is pretty much expected to come in line with that at 3.48 in 2023. Now, in terms of the valuation for McDonald's, and this is one that I do hold myself in my own portfolio, I have mentioned it in other videos, it is one of my top core holdings. The intrinsic value comes to around $304, which is the average of these four models. Current price sitting pretty at $291. Margin of safety, if we start off with 10%, remember it's if it has a wide moat, strong financial metrics, good forward-looking data. It's in a buy up to 274. Now, if we move that to 5%, we can pretty much see it is trading right now at a margin of safety of 5%, which for the majority of people is too little of a margin of safety to be adding shares. In terms of Wall Street, well, they believe it's going to go even higher than the essential intrinsic value we've calculated, and they do see essentially a good 10% upside. So in conclusion, for McDonald's, we see around a 5% margin of safety at current trading price, with Wall Street expecting around 10% upside over the next 12 months. This brings us to our third stock, which actually reported their earnings today. They had a miss and a beat. Around $65 currently trading in the market, down 22% year to date, and we can see from their earnings miss today, they are down 3%, near that 52-week low, and they do offer a yield of 3.5%. Now, if you're holding this over the last 10 years, not the greatest, only a 30% shareholder return, and we do see it peak at around $90 in the middle of 2023. So let's take a look. Dividend safety score 90, very safe, 39 billion. It is a mega or large cap company. Recessionary metrics, well, they increased the dividend, pretty much flat sales, and they still outperform significantly with only a negative 12% return versus the S&P's negative 55. Dividend growth, very, very nice to see, nearly in line with McDonald's at 9.3% this year. 2% over the last 5 years, so not that great if you have been a holder for that time. But over the last 20 years, 7% compounded annually on average, something that I would live with overall. Now, two things to note here. Because they have essentially been holding that dividend for quite some time over the last few years, they have only been increasing the dividends for the last 3 years, but they have been paying dividends for the last 125 years without a reduction. Now, dividend yield theory, what we can see, some signs of undervaluation, 3.64 versus the 5-year average. Likewise on the forward PE, 14 versus 16. Now, when we look at the sector PE, it is significantly higher at 19. Now, just one thing to note, just because a company is towards its 52-week low, it doesn't necessarily mean it is a signal for undervaluation. Likewise, a 52-week high would not be an overvaluation signal. Free cash flow payout, well, it's below the 70% that people tend to use for the consumer staples. 61 in 2023, 2024 expected to go even lower, so we can see why it does have that very safe dividend score. Pretty much flat on the free cash flow over the last 10 years, $3 to $351. But do note, 2024 is expected to go up to $466. Sales growth, it is keeping up in line with inflation over the longer term on average at around 3 to 4%. 2023 at 6% was very nice to see, with the year before at 5%. And we can see the inconsistencies over the longer period from 18 billion to 20 billion. Shares outstanding, yes, they do share buybacks, but we can also see the trend. They did issue shares in 2018, so a mix, but over the longer term, they have bought back around 45 million worth of shares, just under 10% of the total in 2014. ROIC, again, a common trend with these companies we've been analysing, well above that 10% consistently over the long term, 2023 coming in at 13%. Free cash flow margin, operating margin. Now, this is an industry, as we've seen in other stocks, that do tend to find it hard to keep up with these averages, around 16%. So it is positive that General Mills, as we can see, has been at least at that level consistently. Likewise with the free cash flow margin. Finally, the net debt to EBITDA, whilst they did have it over the maximum in 2018 to 19, it has come down now significantly to 2.8, with 2023 in fact expected to go even lower. So they do have a decent balance sheet as well as having a fairly safe dividend. Now, valuation, and as always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. Intrinsic value coming to $74. Now, current price at around $64. If we start off with a 10% margin of safety, it is a buy up to 66, pretty much near that current trading price. So you could argue you are getting between a 10 to 15% margin of safety on the current value. Wall Street, well, what do they say? They see over the next 12 months the price to go up around 10%. So in conclusion, for General Mills, we are looking between a 10 to 15% margin of safety at the current trading price, with around 10% upside per Wall Street and their targets. This brings us to the final stock for the recession proof in today's episode, Hormel Foods Corporation, ticker symbol HRL. Down 31% year to date. It hasn't had the bestest of years, pretty much at the 52-week low with a yield of 3.6%. Now for those, if we take a quick look, who've been holding over the last 10 years, up 40%, but we can see it has had periods where it has decreased quite significantly, and it would have taken you quite some time to get back to the original price, so something just to bear in mind. Dividend safety score 99, very safe. Market cap 17 billion, a large cap company. Those recessionary metrics, well, they increased the dividend during the last recession, negative 4% sales, with another significant outperformer versus the S&P 500. Dividend growth this year was very disappointing, below that inflation that is very uncommon from Hormel Foods. The last 5 years, 8% on average. The last 12 or 20 years, 12%, double digits. Now, they are a dividend king, so it is important to note that they have been increasing the dividends for the last 58 years or more. Dividend yield theory, well, this is incredible. It is pretty much the highest yield they have offered over the last 5 years, so we do see a sign of significant undervaluation. Likewise on the forward PE, pretty low in comparison to that 5-year average. Now, it is slightly higher than the sector PE. Now, when we take a look at the free cash flow payout, it has in fact been increasing over the last 10 years, so that is a bit of a worry. It is something I would keep an eye on. 2023 coming in at 77%. Free cash flow per share, we do see it not as consistent as we would like, but it has increased over the period from 111 to 142. In particular, sales growth, very mixed. We do see pretty much nearly a positive year followed by a negative year. And when we look at 2023, they did in fact have a decrease to their top line. Numerically, this is how it translates, 9.3 billion to 12.1. They are in actual fact the only one that we have looked at today that didn't do share buybacks over the last 10 years, having increased or in fact diluted your position by 9 million shares over the long period. Nothing massive, but something just to take note of. And whilst the ROIC has been pretty strong above that 10% we look for, it is going down in a decreasing manner. So something, again, just things as an investor or potential investor to think about. Consumer staples, again, remember, it is one that they do find it hard to keep up in the margin front, and it has been fairly decreasing over the period, sitting at 9% in 2023, with the free cash flow margin pretty consistently around 6 to 8% over the longer term. Net debt to EBITDA, though, they do have a very strong balance sheet, 1.36 years to pay off all of their debt net of cash on hand in 2023, and expected to be in line in 2024. So we can see why not only that dividend is safe, but this company does have a fairly strong balance sheet. Now, the valuation model, as always, if you enjoy the content, smash the like button, hit the subscribe and bell button. But also, if you do want to grab a copy of this intrinsic value calculator to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, do click on that pinned comment below. Now, margin of safety, what we typically start off with, 10%, shows that it is a buy pretty much at the current trading price. So similar to the other stocks, it is around a 10% margin of safety. Now, what do Wall Street say? Well, they believe over the next 10 months or 12 months to have around 5 to 10% upside. So in conclusion, for Hormel Foods, you are looking at around a 10% margin of safety with around 5 to 10% upside over the next 12 months. As always, let me know your thoughts in the comments below. One, whether any of these are companies you have been adding to with the thought of them being recession proof, or maybe you think they are still overvalued, or you would be looking at a much more significant margin of safety for each one. As always, smash the like button if you've enjoyed the content. Let me know what you're thinking of this content, if you like it, if you want other content, or if you want more of the same. And as always, I will catch you all on the next episode, and take care.